Good afternoon, everyone. It's such a pleasure to see you here. I can't see the people who are online, but I'm given to understand that there are quite a number online, and now we're in the modern world. For those who don't know me, I'm Carolyn Wilkins. I'm with the Griswold Center. Teach a course on financial crises. The gift that keeps on giving, we're going to hear about that. I'm also on the Bank of England's Financial Policy Committee, where we talk a lot about stable coins and new forms of payments and how they interact. So it is just such a pleasure to welcome Dan Awrey. He is the Beth and Marc Goldberg Professor of Law at Cornell Law School. He's one of the leading scholars in financial regulation. His work spans, I'm gonna get this, banks, investment funds, derivatives, payment systems, and all the infrastructure that wires these things together. He's advised institutions ranging from the Bank for International Settlements to the US Treasury to the Bank of England, Canadian Department of Finance, and his research has appeared in many of the top law journals. He's also co-author of the textbook entitled Principles of Financial Regulation, and he's the founding co-managing editor of the Journal of Financial Regulation. The book that we're going to discuss today, which is called Beyond Banks, Technology, Regulation, and the Future of Money, was published by Princeton University Press, quite proudly, I imagine, in 2024. Dan, he earned his BA and JD from Queen's University, LLM from the University of Toronto, and his doctorate from Oxford. And if you didn't already know that he's Canadian, the Queen's Toronto University combo really gives it away. It's the academic equivalent of maple syrup and hockey. So when I first picked up Beyond Banks, I really didn't know what I was going to read, but I figured it was going to be something about fintech or crypto or both. And what I found instead was a sharp rethinking of what I call the topology of the core of our financial system, how money, payments, and financial intermediation are wired together, how that came to be, and how they've evolved over history. And so it's absolutely fascinating. But in my mind, what makes it really stand out is that it doesn't take what you so often find in these types of books, these ideological stances, we really believe in old-style banking, or I really believe in the ambition of, and I'm optimistic about fintech. Instead, what he does is he asks really deep design questions, and we'll hear about them. Are we actually seeing a safer, more open system as we unbundle the core functions of money and payments? And if not, what can we do about it? And as we know, the people here today obviously have an interest and want to learn. We've got a world where we're thinking about CBDC, stablecoins, crypto, unbundling of banking, and we've got new rules like the Genius Act. That's not the only legislation. So from our point of view, we're happy to have them because these questions are not only important, I think they're more urgent than we could have imagined, maybe even when you were writing the book. So over to you, Dan.
Thank you so much for that incredible introduction, Carolyn. Thanks for everybody coming. Thanks especially to the folks at the Griswold Center for what I think has to be just about the best organized one-day visit I've ever encountered. I am fully caffeinated already, having now had several coffee chats with people this morning. I'm consciously slowing myself down because my caffeine levels would probably get me through this talk in about 90 seconds. I wanted to just pick up on something really quickly that Carolyn said. This book came out almost a year ago. The good folks at Princeton University Press had me working with the New York Times on an op-ed that was meant to presage the release of the book. It was pushed back a couple of weeks. And if you look at the calendar from a year ago, what a couple of weeks looks like, the book came out on Election Day last year. As the op-ed was supposed to come out. And because of the election, I got a one-sentence email from the editor that said, "Can you make this about crypto?" And I said, no, I'm sorry, I can't make this about crypto. And that's why you didn't read the op-ed in the New York Times about this book, because it didn't exist. A lot of this is, and the book is sort of self-consciously pitched this way, this book isn't about crypto. I think the book actually says that on page 3. It's about longer-term issues in experimentation, in money and payments, and as a backdrop to where we find ourselves now, which is in the middle of 1,000 experiments in money and payments. The book has a central conceit that I'm not going to talk about very much, which is my attempt to reframe Gresham's law that bad money drives out good for the digital age. The central observation being that consumers make choices not on how good their money is, but how convenient their payments are. And in a world where convenient payments are not successfully bundled together with good money, that means that technologically driven, more convenient, more versatile payments may be leading consumers into places where they could lose their hard-earned money. I'm going to leave that highfalutin framing behind for a moment, because the last year, I think for lots of people, has brought into sharp relief the type of issues that I'm talking about. So I'm going to go with the blunt force version of this presentation, in effect. And then we can come back, as people want, to the fancier theoretical components of the book, if you wish, in the Q&A. All right, this is a bank. There is one other lawyer in the audience. Whenever I do this at a law school, they're like, oh, look, it's a nice courthouse. We're going to talk about courts. Isn't this fantastic? We're not in a law school, so you will all understand that this is a bank. Really, for the last 150 years or so, we've been trying to figure out how to make banks safe sources of money. We have come up with a configuration of laws and institutions that largely achieves that objective in the form of bank chartering, prudential regulation and supervision, things like FDIC deposit insurance, bank resolution, and the discount window and other elements of a lender of last resort. It's not perfect. It creates enormous distortions, but for most people who keep the vast majority of their money in an FDIC or equivalent insured deposit account, it does the job of making sure that their money has a stable nominal value. This was not easy, and one of the things that I think I always want to state when I talk about the book is that part of the reason I go into all the history is that we failed at this a lot before we got to a version of this that is even remotely successful. And even then, the remotely successful version has led to incentive problems that I think in very real ways fuel financial crises of a more recent vintage. A lot of the conversations about money, and especially new money, stop here. That this is a story about laws and institutions, and ultimately comparing bank money to other types of money just isn't really a comparison at all, because other money doesn't have the same legal and institutional setup. That's true, as I'll come back to in a moment, but the part that always gets neglected, and I am going to say this because I'm a payment nerd of 30 years standing, is that there's the other side to this, which is that there is an infrastructure behind all of those banks and behind their monetary commitments that makes those monetary commitments useful. That is the ability to make payments from one person to another via the conventional banking system. Now, I don't want to overgeneralize, but I live and work in the United States, and I bank in the United States. And one of the things, as both somebody with a background in financial technology, but more importantly, somebody who's lived outside of the United States for large parts of his life, is that all this good money comes with really bad payments for all sorts of reasons, some of which aren't directly relevant to the book. I often get asked why I don't talk about credit cards in the book. The answer is there's a guy named Sean Bonata at the University of Glasgow who wrote a book on credit cards called Plastic Capitalism that would do a better job of understanding the rise of those type of payment instruments and institutions than I ever could. But when it comes to banks and the technological infrastructure in the United States and in many other countries, not surprisingly, they haven't been great. There are all sorts of reasons for this. This book goes into some of them. The consolidation of the US banking industry in the 1990s and the resulting need to meld together the IT infrastructures of a whole bunch of banks that weren't really fit for purpose at the time was then exacerbated by the fact in 2001 you get the first commercial API The biggest IT investments the US banking system ever made through the 1990s were redundant. The technology became obsolete in 2001. Nobody wanted to make those investments again in the next generation of technological infrastructure, including web-based APIs. The next book is largely the story of this, and in particular its impact on community banks in the United States, but you'll all have to have me back for that. As part of this technological patchwork of the US banking system, it's been pretty costly to do things like upgrade strong cybersecurity. Bank fraud algorithms are notoriously poor. We can talk about this in Q&A, but you can compare Venmo or PayPal's fraud algorithm to Zelle, the bank-based equivalence algorithm, and realize that it's an order of magnitude less effective at detecting fraud in anything resembling real time. And of course, banks have spent remarkably little money on payments hardware. In fact, when you think of all the payments hardware that you've had to deal with in your life, whether for those of us that might be a little older in the audience, the old magnetic card readers, or even farther back, the carbon paper versions, to things like the point of sale devices, dongles, and now our phones, is that despite the fact that US banks and global banks are really at the heart of the payment system, they have played almost no role in developing payments technology that we use every day. This is just something that banks have been on the periphery of. They've been free riding off other people's investments in technology for a long time. So this is in effect the old world, where eventually we have good money, but it's come at the cost of some pretty inconvenient, costly, slow, not particularly useful payments. We can compare this with the New World. The New World still involves banks. I often get accused of saying that I'm predicting the demise of banks. I'm not. I'm just observing that the world of money and payments now has players in it not called banks. I'm giving you an example here, Venmo, which I imagine many of you know about, and Circle, which is the issuer of the world's second largest stablecoin, USDC. I have changed the network structure here in a very purposeful way. Note that all the banks in our previous system were connected to one another. Here, however, Venmo and Circle are only connected to one bank within that system. This is to reflect the reality on the ground. Up until, well, really the passage of the Genius Act this past July, Venmo can't connect to the banking system directly. It has to connect via a bank that itself has access to the system. This has a couple of implications that are important in the book, one of which is that this creates the opportunity for their partner banks to effectively be competitive choke points. If you look at what JP Morgan did recently by starting to charge fees for sharing data with third-party service providers, that's exactly what I'm talking about. If you look at the price of those fees, they are exactly the marginal revenue that they think that third parties are going to get from using JP Morgan's data. They are trying to price competitors out of the system, in effect. And they're not shy about that, explaining it in those terms. Circle highlights the other potential problem here. When Silicon Valley Bank failed in March 2 years ago, Circle had $3.3 billion of uninsured deposits in Silicon Valley Bank. Why? Because crypto firms need to make payments too. They need to hold customer funds somewhere. But this becomes a clear point for cross-sectoral contagion. The bank fails. Large quantities of deposits are sitting in the bank on an uninsured basis. USDC falls to 84 cents on the dollar briefly on resolution Saturday before we ultimately get the triggering of the systemic risk exception that bails out not only large parts of the US banking system, but also Circle. And so we have this evolving infrastructure that has two features. One, institutions that are not banks. There aren't many things that make Venmo and Circle comparable, but one thing is they're not banks. And the second is that these institutions that are not banks still need to rely on banks to get network access to be able to make payments across businesses and households. These firms do a few things really, really well. I'm going to give you the trivial example of what actually being an internet native firm that uses modern web-based APIs enables you to do. Venmo, for example, enables you to split restaurant checks with your friends. There are a lot bigger applications out there in the world. Payment data is a far more accurate predictor of your likelihood to repay, far more valuable in terms of people designing financial products and services to suit your specific needs, and to be fair, to exploit those specific needs. But all of it requires a modern web-based interface, a way of sharing that data. Venmo has that, Circle has that, API native firms are built around it, in effect, in a way that enables us to provide a whole bunch of products and services that we previously couldn't do. I was talking with Aviv before. One of the things we do now all the time that we couldn't previously do, if you have multiple financial services providers, but you want to have a single snapshot of all of your financial information, there are intermediaries out there who will gladly enable you to aggregate that data and give it to you in a single dashboard, understanding your entire financial health. That requires a data architecture for which these firms are tailor-made, but for which conventional deposit-taking banks often are not. Once you've got all the data, once you've got web-based tools to analyze that data, then things like cybersecurity, fraud protection become much more, at least in theory, capable of being as robust as we can hope they would be. We also start to see then new investments in the hardware of payments. The best example here, I think, is the firm Stripe. I talk about Stripe a little bit in the book. For people outside of payments, Stripe is one of those firms that's very hard to understand. For people inside payments, Stripe is one of those firms that's very easy to understand because it's the plumbing. It's all the parts that are necessary for you as a consumer of a payment to make a payment quickly, for businesses to be able to process those payments quickly and to integrate them into things like their accounting or tax software. And for banks, they're the ones that are writing the APIs that slowly, surely, and awkwardly are enabling banks to connect to these systems. But then the part you all know. Venmo, Circle have historically sucked at the other element of this, which is the good money component of this. The book goes into a lot of detail about this, but really the only thing I want to highlight is that century and a half of legal and institutional experimentation and learning that we did for banks, we are just at the very beginning of when it comes to non-banks. And there's still an outstanding question of whether we want to do it for non-banks or whether we want to stuff this all back within the conventional banking system. But for these institutions, we don't have deposit insurance. We don't have non-bankruptcy bankruptcy. That is, we don't have resolution. As I talk about in the book, as I've sort of, I suppose, said ad nauseum in connection with the Genius Act, bankruptcy is the kryptonite of money. Bankruptcy is engineered to do a set of things that are the exact opposite of something that maintains a stable nominal value and can be easily used as a medium of exchange. Bankruptcy stops those things from happening. And as a result, is just antithetical to good money. So what do we end up with? We end up with a conventional world with relatively good money, but kind of old and increasingly out-of-date payment networks. And we have some fast, whizzy payment networks that have a problem in terms of the credibility of their monetary commitments. This then leads us fundamentally to a problem. The problem is that, and this is where, when I sit down with central bankers, we have to have something of a come to Jesus moment, is that consumers could care less about our models of the way that the banking system works and how finance works. Consumers care about specific things and they don't care about other specific things. If I was starting as a researcher today, the thing I'd be seeking to understand is how consumers make decisions about the way they pay. Because there seems to be growing anecdotal evidence that what they care about is the convenience, cost, and other features of their payments, but don't really regard the safety of the monetary commitments that are associated with those decisions. So if Venmo lets me cut a restaurant check between my friends, if it makes it very easy for me to aggregate a whole bunch of money so that I can go and then pay the hotel for a destination wedding, actually something that one of my colleagues did, had $110,000 in his PayPal account before hearing me give a talk about the treatment of that money in bankruptcy, then they're going to do it. They're going to get short-term benefits now, and who cares about the long-term cost? They're amorphous. I don't want to learn about bankruptcy. We have a predilection for bailing out financial institutions that aren't banks anyway. Why not just take the short-term gains and not worry about the longer-term costs? There's lots of theories for why we might do this: hyperbolic discounting, salience, all sorts of behavioral characteristics that I personally don't think we know enough about, but which may be driving then a situation where all of these good payments, because they're not bundled together with good money, are actually driving us into risks within the monetary system, and in particular, to hold monetary instruments that are subject to bankruptcy, whether it be your PayPal balance, USDC, or one of the other 1,000 alternatives that are blossoming out there. I'm going to keep the rest of this short. I always hate the part where I have to say what I think I'm trying to do, because I'm a firm believer in letting the people who are kind enough to read my book to determine what they think I'm trying to do. One is I'm trying to reclaim the idea that good money and good payments, monetary policy in the institutional sense and payments policy, are completely different things that we've bundled together for too long because it all revolved around banks. In reality, I want my money to do two things. I want it to maintain a stable nominal value, putting away real value for the moment, although we can certainly bring that into the discussion. My proposal does have implications for monetary policy. And we want it to be accepted as a medium of exchange. And then the fact that we want it to be accepted as a medium of exchange is then the overlap to an entirely separate area of policy, payments policy, that looks an awful lot different in terms of what we're trying to get out of the world and has a fundamentally different set of tools, right? So if good money is all about laws and institutions that are designed to make credible monetary commitments, good payments policy is all about network design, governance, and how we harness technology for the public good. These are very different things, and this is going to have payoffs at the end of this when I talk briefly about the Genius Act, because we sort of learned the lesson about good money, although we're still some distance away from it. But we've totally ignored all of the law and policy necessary to promote good payments. I also, because I'm a law professor, we're contractually obliged to do this, sort of have a series of proposals that are then built along these lines. And again, it reflects that good policy is different between good money and good payments. Good money is all about the microprudential safety and soundness of the institutions that issue the credit that serves as a form of money. Banks and bank regulation have one way of doing this, but it's not the only one. And we're learning that from experiments all over the world right now, whether it be the Genius Act, the European legislation around MiCA, the recently introduced Hong Kong stablecoin legislation. All of them seek to do this in different ways. But what all of them share in common is that they're realizing that the peculiar institutional setup of banks that combines finance, money, and payments is only one institutional configuration. And you can actually solve money problems, problems of monetary design, by cutting out the finance component of it to some degree. That's the essence of this proposal at a very high level, is to take the finance and therefore the market risk, the credit risk components out of the institutional setup, and then just solving for the monetary issues. The particular way that I seek to solve for the monetary issues is just one of many. I sort of put forth this idea of a no intermediation firm, not unlike classic narrow banking models, at least in theory, although very different from the normative proposals that have often accompanied those models. And then saying, look, I'm a lawyer. Heck, I'm a corporate finance lawyer. I know how to engineer a balance sheet to make sure that a particular class of claimants can always get 100% nominal return on their money. I can use equity capital instead of other forms of debt. I can use over-collateralization of the collateral pool. All of these things will get me to where I need to be. And that's a great conversation. I hope we talk about it. But then the other half of this conversation is the part that seems to get forgotten, that in a world where there's a lot of technological disruption, a lot of institutional disruption, so beyond banks being important sources of money and payments, we have to figure out ways to connect them. And at the moment in the United States, we're at a particularly sort of stark point away from that objective. So only banks get access to Federal Reserve master accounts, which are the legal and operational precondition for participating in the banking system. I would say we need to change that. We need to have an open access rule. Different trains should be able to ride on the rails so long as we can do the other thing, show that the trains are safe. From there, we have a system that is highly fragmented and largely in private hands in terms of financial market infrastructure that is predominantly owned and controlled by banks, the incumbents, for whom that status quo works perfectly well. And again, I would see here something along the lines of what I call an interoperability rule. This is a set of rules designed to force incumbents to keep markets contestable. Not necessarily contested, but contestable. You have to be able to let non-members into the club, and you have to have a way of allocating the costs of integrating old tech with new tech, and then dividing up the spoils in a way that's designed to create a technologically and competitive neutral playing field. We still have a long way to go in the United States with open finance. I mentioned JP Morgan before. It took the CFPB 14 years to come up with a draft rule of Dodd-Frank 1033, which was designed to create or promote the development of this open architecture. We are now way behind a lot of other jurisdictions who actually offer us valuable lessons in what worked and what didn't in trying to give consumers more autonomy over their data and through that mechanism to create a less unbalanced competitive playing field for customers. And then last but not least, and we've tried this in the United States and elsewhere and failed miserably. Canada is a wonderful example, in my view, of bad payments governance, is that the payment system affects everybody. It affects individuals who get paychecks. It affects individuals who collect social benefits. It affects small businesses disproportionately to big businesses in terms of the margins that they ultimately have to pay for their payments. And many of those margins ultimately find their way back to consumers in the form of higher costs. It is plumbing for sure, but when your plumbing doesn't work, your house isn't going to be nearly as vibrant or valuable as you'd otherwise want it to be. All of that is a reflection, in my view, of bad payment network governance. I'm going to stop talking now, but I did promise I would say something about the Genius Act. For my sins, I had to work on the Genius Act, both with the Senate Banking Committee and the Treasury Department. I think there were some lessons learned. I think both Dems and Republicans saw bankruptcy as a potential problem with the credibility of stablecoins. But it did not do what myself and many others recommended, which was to remove stablecoins from bankruptcy or to appoint the FDIC or a regulator as the receiver of the bankruptcy process. Because what's going to happen now the first time a stablecoin goes bankrupt is nothing. Nobody's going to step forward as a trustee because there are no assets in the estate of a stablecoin issuer that can be used to pay the trustee. In the absence of a trustee, the bankruptcy process cannot move forward, and it will stall. And it will stall all in the shadow of an automatic stay that means nobody can take their money out. And there will be a slow, painful death until Congress decides that, wait a minute, we have to give somebody the legal authority to sort of move this process forward in a way that's in the best interests of the customers of these stablecoins. This is the only option that the Bankruptcy Code, as amended by the Genius Act, considers. There are no other options that comply with US law. This is going to be a debacle, and my only hope is that we learn a lesson from it. Still, there are some good things there. Most importantly, the relatively narrow range of backing assets that are contemplated by the Genius Act for stablecoins. The two things that really bug me about the Genius Act, though, are one, we got almost nowhere with the policy around network governance or how to integrate new technologies into existing financial markets infrastructure. There is a throwaway line about interoperability that I'm pretty sure nobody in the Senate understood what it meant. My biggest contribution to the entire legislation was that NIST, that beautiful body within the Commerce Department that never gets enough of the credit for anything, has to do a study to understand how to deal with the clearing interoperability issues around connecting stablecoins to the conventional banking system, but really nothing else about how we connect the world of stablecoins to the conventional banking system, other than the current model where these institutions flow through banks. Now, that's fluid at the moment, but I think it's an oversight. We had an opportunity there that we missed. The last thing I'll say is that the really weird part of the Genius Act is that we should have been doing this for the entire non-bank payment ecosystem. We shouldn't have been doing it for crypto. One, I'm not entirely sure that there's a definition of crypto distributed ledger technology in the Act that is at all tractable. Two, it's not clear to me that US policy should be tilting the playing field in favor of a specific technology. There may be a case for that, but it has not been made yet and was certainly not front and center in the discussions about the Genius Act. And I think looking down the road in future years, what I expect to see and what I'm sort of already tracking through the data that I can get my hands on through PitchBook and other sources, I want to see how much money, how much investment is now flowing into crypto-based payment systems that might have otherwise been flowing into other investments. I've gone on way too long. I'm going to stop it there and turn it back over to Carolyn.
Well, thank you. What I thought I'd do is ask you a couple of questions and then turn it over to the audience. So maybe I'll start where you ended. And there's such a huge gains to have a lawyer think about these issues, not just economists, because your perspective really turns it into a wholesome kind of discussion and relevant for economics. No, but it's true, because you're talking about the Genius Act, and in your book, you talk a lot about how the law actually shaped the market structure, in a sense, and constrained it in many ways, and gave the advantage to banks, just as there's a few examples in your book like that. And I wanted to just push that just a little further, in the sense that one of the big misses in the Genius Act is there's no access to the Fed balance sheet that stablecoins have, but banks have them, have access. That's super important to fixing liquidity issues in market, the FDIC, or any other recourse to kind of a backstop, can stop runs, all like deposit insurance does. And so my question to you is, should we be thinking about the state's balance sheet, and by extension the Fed's balance sheet, as a form of financial market infrastructure, or as part of the ecosystem that needs to be brought in a wholesome way, in money and separately in payments? And how can they do that without making the Fed, just if we want to focus on them, kind of the market maker of first resort and not last resort? Because market discipline, consumers or users of these services aren't going to ask questions or think about things until it's too late. So how would you operationalize that in, I guess, what will probably be some adjustments to the Genius Act over time to address that problem?
Yeah, I think there's a series of bundled sort of trade-offs in there. So I would agree that the Fed's balance sheet is financial market infrastructure. I would say, though, that there are moving pieces that then mean that what the optimal piece of non-bank access to Federal Reserve master accounts would kind of depend, and how you wanted to design that, would kind of depend on things like your monetary policy framework. So to give a sort of an old school analog example, the use of daylight overdrafts, which is something that the Fed has historically done to grease the wheels of the payment system, has a value in a scarce reserves monetary policy framework that it sometimes does not in an ample reserves framework, right? Mm-hmm. If all the banks have ample reserves, what do we need overdraft for, effectively, right? And so the two are going to be related no matter what. We're in an ample reserves regime, and in my mind, the question then is, well, do we want to look at and then influence the distribution of reserves within that system? Because it's all well and good that JP Morgan has a whole bunch of reserves, but what about the 9,433 other IDIs in the United States, plus all the stuff that we're talking about here? From my perspective, I would also like to ask the question about how we design our system from the types of access to the Fed balance sheet that we have. So to me, there's three intertwined variables here. One, sorry, I answer short questions with long answers, and I apologize for this. But it's a great question, and we should think about it.
This is an interesting answer, so keep going.
Okay. If it's not interesting, let me know. We'll cut it off and move ahead. We should have come up with a hand signal in advance.
The secret sign.
One is, do I just want them to have intraday access to the Fed's balance sheet? right? Do I want them to be able to hold balances overnight, or do I just want them to have access to the balance sheet as a source of intraday liquidity so that we reduce sort of the frictions from taking the assets on a stablecoin's balance sheet, having to sell them for the purposes of generating liquidity? And that, I think, is the safest version of this particular model. It is, I believe, the model that the Bank of England, not for stablecoins, but for non-bank payment platforms that they started with, it was intraday liquidity only. Then the next question is, if overnight, one, am I giving them access to the discount window? Am I really going to give them access to the lender of last resort function in effect? And then two, am I going to give them access to the interest on reserves system? And this is where I think this gets really tricky and where I'm spending a lot of time. I know that there's quite a few economists who are working on this as well. Sort of my friend Daryl Duffy at Stanford being prominent among them, where I think we still need to sort out the trade-offs there, because then, of course, the answers to all three of those questions have implications for the conventional banking system as well. I feel like I'm not answering your question, except to say that I think there's now this series of trade-offs once you open the door to the central bank's balance sheet ex ante, that then you've got to answer these design questions about what you're trying to get out of the system.
Yeah. So I think that's right. They're going to have to get there. When you look at history, you look at the free banking era, for example, and how that evolved, there's always some sort of backstop that needed to be introduced in some way or another. So to keep that no questions asked kind of wildcat banking problem at bay. There's a related question though, because every time you give access or you can have interoperability, you can create access, but fighting against what are kind of naturally network effects that lead to oligopoly power is really hard. And I loved in your book this monopoly board analogy where the banker kind of owns every square until they don't. So I guess you did try to address that by saying, well, we'll have open access, we'll have a payments charter. I'm wondering, are there things that are niggling in your brain that kind of say, I wonder if that's going to be enough? And and there were things that niggled in my brain, and this is a really hard problem, so it's not a criticism, but it's things that are in the ecosystem, like all the infrastructure and the fixed costs with know your customers, like the biggest example, where even if I want to contest, I can't afford it because I have all these fixed costs. Even if I have access, it's not enough. And so what do you think of the other bridges that might need to be thought through to really get what you're aiming for, which is contestability?
I'll focus on interoperability component of it because myself and Josh Macy at Yale, we wrote a paper a few years ago on the clearing and settlement architecture of securities in the United States. Where in the 1960s, we have this backlog of paper that then the SEC says, okay, we want the exchanges and clearinghouses to invest in moving to these fancy new things called computers, right? At the time, what would ultimately become the NASD and eventually the Depository Trust and Clearing Corporation had about 60% of the market in clearing and settlement. It was the biggest player. And the rules just said you had to make it interoperable. So the Pacific Stock Exchange had to connect to the Chicago Stock Exchange, to Philly, to Boston, to NYSE. Of course, we flash forward 4 decades later, and none of those exchanges or clearinghouses exist anymore. Every single one of them was bought by the DTCC. And the reason was that that SEC interoperability requirement, which was designed to create competition across a market structure, actually just fostered consolidation. Why? Because a mainframe computer in 1974 cost $5 million, which was about 40% of the Chicago Stock Exchange's net revenue that year. They couldn't afford to make the changes necessary to compete with what would become the DTCC. The DTCC knew it, and so started making all of these investments and then saying to the smaller providers, hey, you got to catch up, the law says so. And that's what keeps me up at night. Because until I can answer the question, and we're working on this, Josh and I, until you can answer the question of the design of the interoperability rule that strikes the optimal trade-off between the fixed and marginal costs of an incumbent system and the connection costs to new players, and then moving to a new technological paradigm, and allocate those costs between incumbents and new entrants in a way that effectively neutralizes the network effects as an anti-competitive sort of driver. I could be just, by saying we should do interoperability requirements, I could be doing the DTCC thing all over again, right?
Yeah.
I could be driving the next monopoly if all we do is say you got to be interoperable without then having a really strong understanding of the economics of that. We've been working on that paper. I am happy to share for 3 years now. It's probably the most technical paper we've ever tried to write, and we still don't have it right.
Yeah.
And so I do think there's, you said things niggling at the back of your mind. There's a 70-page thing niggling at the back of my mind.
I figured there must be.
That is still, I think, fundamentally necessary for us to move that forward.
Yeah, and I don't think the U.S. is the only country that's dealing with it. You made this comment about Canada. Might not use the same term about the governance, but clearly there's a small number of very high-performing financial institutions who were involved in money and payments and intermediation, and there's a lot of commercial interest, put it that way, and then there's a really vibrant challenger community. And so anything you have to say about the U.S., you probably learn a lot from Canada. I think that, well, if you want to comment on that, you don't have to, it wasn't a question.
No.
But I know there's probably a lot of other people that would love to ask questions. We're going to 1:15, right? So I thought I would, yeah, okay.
Hi, Brendan Greeley. I'm in the history department here. One of the things that's happening abroad that's not happening here in the United States is that central banks are creating interoperability for small payments attached to bank accounts. So I'm thinking of PIX in Brazil. We seem to have made a decision not to do that here. And in fact, we've passed laws saying we can't do that here. And I'm wondering is the challenge to doing something like that for small payments that are intermediated by banks that work immediately, is that political in the sense that there are certain institutions that don't want to lose the money they're making from small payments? Or is it architectural? It's just too difficult to rebuild the system to make that possible?
I think it's that and legal. So I'll start with the legal point. I'm a lawyer, so I might as well start there. We have a peculiar system in the United States where Congress has said first that when the Federal Reserve comes to building network infrastructure, it has to do so in a way that doesn't cost incumbents a dime, right? Section 11D of the Monetary Control Act of 1980 basically says the Fed can coordinate the building of new infrastructure so long as it comes at absolutely no commercial cost to incumbents. That's not exactly what it says, but that's what the Bank Policy Institute says it says. And since they have a huge amount of political influence in Washington, that's what policymakers think it says. So that's a big problem. Compounded to that, Congress has also said in Section 13.1 of the Federal Reserve Act that this is only a bank thing, right? Network access is something we give to banks. This is something that's been litigated. It doesn't even apply to all banks now with the custodial litigation and the Fed's intervention to say that there are 3 tiers of potentially eligible banks that can access the system, that now only banks that aren't weird banks get access to the system in effect. If you're a crypto bank, if you are a Custodia, a special purpose depository institution in Wyoming, current law says, sorry, we have the ability to say no. And we have the ability to say no under the pretense, which is not unreasonable, that the crypto ecosystem exposes the network to unreasonable levels of AML, CTF, so money laundering and terrorist financing issues. I would say those are the big reasons. There is, though, the underlying then architectural reason, which is then that because this is basically, those 2 laws basically keep everything other than banks out of the network, is that the network has evolved in this very idiosyncratic way where it's halfway between an old school mainframe in a basement network and a new school web-based network that is very difficult to manage and hold together in ways that have fundamentally sort of slowed down, I would argue, stopped any sort of network upgrades that, for example, happened with PIX, where effectively the Central Bank of Brazil says, you know what, for $5 million, I can replace my existing wholesale clearing and settlement system with a web-based API that then allows, I'm going to force my banks to write to the API, which means I'm going to force them to do the technological upgrades that we've never forced the US banking system to do. And then all the digitally native firms are going to be able to sort of connect to it because they're digitally native firms. So the answer is both, I would say.
Thanks. This is fascinating. I had a question about thinking about the interoperability and competition issue from a supervisory angle, right? So if you think about policy, is there a world in which if you had fewer competitors and you could supervise them more closely, that's better for the banking system? And that could be an argument for not being as worried about having a whole slew of competitors out there who might have different standards and make supervising very difficult.
Yeah, I come across that intuition, I think, fairly often. Now we're going to have to talk about Canada effectively. Canada has a strange set of trade-offs where it has a dominant set of financial institutions that also, in my view, dominate the payments governance. Having a small set of institutions is a pretty good deal for OSFI, the Canadian banking regulator. And in some respects, for a small number of new entrants, it's enabled a certain level of manageability around incrementally experimenting with expanding the scope of the network. I don't think they've done it perfectly, but I think that's the direction of travel. And I think part of the reason that they've been able to do it is because a small concentrated universe is just easier to deal with. Now, the flip side of that is that if you're trying to create an open network infrastructure, it also has costs. So the Canadian version of open banking, I don't know how many people know this, we call it consumer-driven banking. The Canadian government has outsourced this to a third-party IT platform, which is now paradoxically the most powerful IT platform in Canada for open banking because we just gave a single private firm the ability to make decisions about interoperability. That's not open anything, that's just, I've outsourced an activity. And so it can go wrong. In the US, we have the exact opposite problem. We have at least 6 different types of bank charters, 9,400 different insured depository institutions ranging from, $10 million in deposits and net interest margins that barely are enough to keep the lights on to JP Morgan. That is a whole different challenge in terms of interoperability. One of the big projects I'm working on now is Americans seem to love the community banking system, but don't want to do anything to actually help it be competitive other than deregulate. And it's going to have to make the technological transition in order to survive. That's just the way that consumer demand is going. And so thinking about the ways other than deregulating these systems by building public infrastructure onto which these banks can connect as a potential solution there. But it's just much more difficult in the US because of the heterogeneity. The coordination costs are huge. And that heterogeneity actually leads to pretty big conflicts between big banks and small banks, between fintechs and banks, that then we have not done a good job of sorting out yet. Which is, I'm making excuses for the United States, but it's genuinely a hard problem. I identify that we've gone down this path, but I don't want to trivialize exactly how hard it would be to try to corral all the horses for a banking system this big and heterogeneous.
I mean, I just want to push you again on this. I think the beautiful thing about the new technology, and here I'm talking about whatever version of DLT you're using and say stable coins, is that it has created a way to at least get around that existing infrastructure and the power that that has, and then make the banks wake up and say, oh my gosh, and the central banks and the international community say, we need to fix the traditional payments to compete with these guys. And that's just a service in and of itself. And I'm wondering if that...
I couldn't agree more with that.
Okay.
Viv and I were talking about this earlier today. As somebody who is in financial technology, such as it was in the 1990s, we were a backwater. Like, we were doing cool and important things that today we take for granted, but it's not like the best programming talent wanted to go into financial market infrastructure. It's almost like I'm chuckling even contemplating this. And even if we did, every institution's architectures were so different that other than the fact that we all knew COBOL and Java, we had nothing in common. You could be at JP Morgan and Citigroup and both in the same IT functionality and not really have the same job fundamentally, and certainly not be able to switch jobs.
Yeah.
What crypto has done, and there's lots to say that I'm not a fan of in terms of the way that distributed ledger architectures work, in terms of the various governance problems and attack surfaces and things like that. But one of the things it's done is brought together a whole bunch of people who are very talented, very energized, and at least some of whom want to solve the problems that have been left over from all the incumbent infrastructure. I hope they take it in the right direction. I think the government, certainly the Fed, should be playing a more coordinating role to make sure they go in the right direction. But I completely agree with you that it's this crystallizing thing that has gotten really smart, talented people interested in these sort of questions, and it would be a shame if we wasted that moment.
Hello, I'm Eleanor, and I'm a student here. And I wanted to sort of dig in further on this idea of like banks getting into payments infrastructure and improving payments. I'm interested in your thoughts on kind of this like subtopic of like banks getting into tokenization specifically, and how that sort of plays in the idea of like good payments and good money, and also your thoughts on like how to address the problem of good payments from like a regulatory angle.
Yeah, so this is a really, really good question. So the version of tokenization I'm assuming you're talking about is just the idea that we're all going to move to, in effect, some sort of distributed ledger rail upon which information travels. Yeah, that faces the exact same problem as real rails face. I think it's possible that we could and probably maybe should go in that direction. But what I don't like to see, and what I'm kind of seeing, is everybody trying to build their own rails. If you're from Australia, this may sound familiar to you. There are, 5 territories in Australia. Each of them built their railways on a different gauge, right? And so when you came to the territorial borders, you had to have switches that were designed to make sure that the rails were interoperable, in effect. Those were incredibly costly and stupidly inefficient. But because they didn't coordinate ex ante around which version of tokenization, they ended up being not great network infrastructure. So I do think tokenization has a role to play here. I think if done well and done in a coordinated fashion, it could be the way that I've been talking about of building in the interoperability between new and old. But that's going to require us to build one set of tracks on one set of protocols. Some of that exists. I think ISO 20, I always get the zeros wrong on that, 20020. This is the data formatting standards for financial transactions. Gives us the format and content of the messages we might send through this system. Now it's just about building the actual pipes through which that information flows in a way that we all agree on. And again, I think to your good payments point, that's going to require some governance on our part. Because we're going to have to answer the question, who gets to connect to these new rails? What are the preconditions for the trains that get to ride on those rails? It shouldn't just be banks, otherwise we move banks to tokenization but not expanded the network, which seems pretty counterintuitive to me. They already talk to each other, they already connect. But for non-banks, under what circumstances can they connect? What are the minimum threshold conditions for cybersecurity, for operational risk resilience and things like that? I think we need to be focusing on that stuff, in which case I have modest excitement about tokenization. Not because I think it's the best solution, but because I think a good solution commonly adopted is actually better than a better solution that only exists in theory.
Mm-hmm.
I also felt like my coffee really kicked in when I was answering that question. Yeah.
Yes, if I may ask a follow-up, I'm
Please.
interested then, to what extent do you think, or in what ways could we see these systems becoming interoperable between sort of private bank-owned networks and public networks? And like, what are the risks in that interoperability?
This is my concern, and this is what we're seeing, right? When JP Morgan makes JP Coin, or when the Regulated Liability Network has 13 banks associated with it, when I see Akura, which is an open finance protocol that is only open to the biggest banks, I think to myself, walled gardens are not the way that this is going to work. But that's what we risk creating if we don't understand what we're building. And that's interoperable network infrastructure. If this is going to have benefits for people, I think ultimately we need to focus on building in those standards now. I know this is probably just sounds like the same answer to your last question in some respects, but this is what I worry about, is I see all these projects. I'm involved in a lot of these projects where you get to the development stage and you've got a whole bunch of people who are great coders and great network architects, but don't understand that, it sounds self-serving to say this, don't understand the history of finance and how we've screwed this up so many times. and that the lessons are really lessons on the appropriate roles of the public and private sector, what they can bring to the table in building infrastructure, not necessarily on the whizziest code or things like that. It's going to take a lot of Mountain Dew, but it's also going to take a lot of sober people sitting with a pencil and a piece of paper and understanding who needs to be at the table and who needs to come away with the minimum threshold conditions for the type of architecture that will actually yield some of the promise that I think people who are excited about this are excited about.
We have time for one more. Hi. So I actually I teach competition law.
Woohoo!
And
There are two lawyers in the room then.
Oh, sorry. Yeah,
Hi.
another lawyer.
At least.
And so my question is about competition policy. And so I'm really excited to read your book to kind of learn more about ways that antitrust law has actually mucked the system up in ways that I think may be unintended or may just be blind to the complexities of the industry, whether in terms of, deliberately or not deliberately increasing consolidation in ways that make the problems worse, ways that it prevents collusion, but that also then limits collaboration in a range of contexts, and then ways that it has made it harder for consumers to bring cases, and thinking in particular about the credit card fee cases and how the difficulties of proof around that and the failure to institute antitrust remedies that have enabled the kinds of like interoperability and non-discrimination duties that you're, I think, presumably interested in. So, and this maybe relates to the other question of like supervision versus, and consolidation with supervision versus other tools. Where do you think you situate yourself in terms of like whether antitrust law is a complement or a substitute to banking reg? And to what extent can we draw from other models, whether public utilities models or other models, to think through solutions?
Wow, a lot of questions and so good. I will count myself in the category of modest complementarities. So for the non-competition lawyers in the room, we have a weird rule in the United States that basically says that the Clayton and Sherman antitrust acts do not apply if there's an equivalent regulatory framework that governs. And finance is full of what courts have deemed to be equivalent regulatory frameworks, meaning that they're not subject to antitrust review for most of this, in effect. I think that's a problem. I think one of the ways that, it's taken us 3 years, Josh and I, to write our interoperability paper. And in the background is, maybe we can't write a perfect rule, and that's where antitrust enforcement comes in, right? And so I'm basically in that camp on that front. I do think in general there's a, gosh, there was so many rich things to talk about in that question. I do think in general that we also take the wrong approach to competition in banking in the United States. If I have to sit through, and sorry to my good friends formerly of the Department of Justice, I suppose, when they think of banking competition, they think of banks doing banking competition. You will not find anywhere out of the DOJ antitrust department any analysis around non-banks competing with banks. And then when it comes to banks, how do they count competition? Branches. I couldn't imagine a worse proxy in 2025 for understanding bank competition. Yes, we have banking deserts in the United States, and that's a problem. But it's not a problem that's going to be solved by competition law anyway. And it's a problem that is measuring the wrong thing because it's the thing that's easy to measure. And so I think the whole debate about bank consolidation, to use like competition law terms, we're defining the market wrong. And we're defining the proxy for robust versus anemic competition wrong by focusing on physical branches in a world where the competition is taking place in cyberspace. And so I think we're doubly wrong in not using competition law where we should, but also in our framing of competition law in the banking sector being 100 years old and increasingly anachronistic. Yeah. Thanks.